our final speaker for day one, David Carlisle, who is the Director of Policy and Regulatory Affairs at Elliptic, where he leads engagement with policymakers and other external stakeholders on cryptocurrency-related regulatory issues. So David will be talking with us about compliance and anti-money laundering, specifically how blockchain networks are being used and how to ensure compliance with your country's regulations. David, this is a topic of great interest to a lot of our attendees, so thanks so much for being here.
Thank you, Jordan, and thank you everyone for having me today. As Jordan mentioned, I'm David Carlisle, the Director of Policy and Regulatory Affairs at Elliptic, and I'm going to talk today about anti-money laundering or AML compliance and regulation for crypto assets. Just before I start, a little bit of information about us at Elliptic as a business. Elliptic is a provider of blockchain analytics solutions that regulated crypto asset businesses and financial institutions such as banks globally use to comply with AML regulation. So our solutions help financial institutions to determine if their customers may be engaging in illicit transactions using crypto assets and to report that information to law enforcement. Our solutions are also used by regulators and law enforcement agencies around the world to assist them in identifying and investigating illicit activity in Bitcoin and other crypto assets. And I'll talk a bit in my slides about how that's done. So I wanted to start by talking about two common myths that many people hold about crypto assets. And the first of these is the notion that Bitcoin and other crypto assets are anonymous, that they're essentially perfect for criminals because you can't see what criminals are doing when they transact, and that it's untraceable. And as I'll discuss over the next few slides, this is really not true. Not only are crypto assets generally extremely traceable, but they often permit a level of analysis that's not possible in traditional financial products. So consequently, companies that use crypto assets are able to operate to very high standards of regulatory compliance. The second myth I'll address in my remarks is the notion that crypto assets are unregulated. I think you may have heard people refer to the crypto asset space as the Wild West. This idea that the crypto asset space is this completely unregulated and ungoverned space. And I think this is also very untrue. While regulation impacting the crypto asset space is still very much evolving and in a developing phase, the regulatory perimeter around crypto is definitely expanding, it's maturing, and it's creating a much more hostile environment for criminal actors, as I'll show you shortly. So let's turn to the first myth, which is the idea that crypto assets are untraceable. Now, I think it's undoubtedly true that crypto assets have played a role in criminal activity. It didn't take very long after Bitcoin was created for criminals to start using it. And the best early example of this was the Silk Road, which was an online dark web marketplace that utilized Bitcoin so that people could buy and sell drugs and other illicit items. And you can see a picture there of the Silk Road, where someone was advertising drugs for sale, where you could purchase those in Bitcoin. And the Silk Road was ultimately dismantled and disrupted by United States law enforcement in 2013. But it was a very large marketplace for several years, and others have risen in its place. We've also seen criminals leverage Bitcoin to engage in other types of online criminality, especially ransomware. Now, ransomware involves criminals hacking a victim's computer and encrypting their files. And in order to get criminals to decrypt your files, you need to pay them a ransom. And overwhelmingly, criminals will request that those ransoms are paid in crypto assets like Bitcoin. So Bitcoin certainly and other crypto assets can be useful for these types of crimes, and especially for crimes that occur entirely on the internet. I think it's important to note, though, that while Bitcoin and other crypto assets have been used in these crimes, it's far from being the case that they are only used by criminals. So I think there are a few features of crypto assets that provide criminals with some advantages over traditional payment systems or with the banking system. But firstly, crypto is a peer-to-peer technology. This means that you don't need a regulated business to transact necessarily. Criminals find it appealing to be able to send funds peer-to-peer without relying on a bank to do that. Secondly, it is decentralized. You can't turn Bitcoin off. There's no Bitcoin headquarters that can be shut down by law enforcement. Thirdly, it is what we call permissionless or censorship resistant. Because it's an open source network, you cannot stop anyone from accessing the network, and there's no way to reverse transactions once they've been made. However, while criminals may find some of these features of crypto assets attractive, there are other features of the technology that make it difficult or unattractive for criminals to use in some instances. Now, what is that? It really starts with the concept of the blockchain. Now, what you see here on the screen is an image from the Bitcoin blockchain. The Bitcoin blockchain, like other blockchains, is an open and public blockchain. Any of the information on the Bitcoin blockchain is available for anyone to view. When you look at this information, if you're not trained to understand it, it looks very indecipherable. What you would see are just lots of numbers and letters, and which represent Bitcoin addresses, but it may not look like anything meaningful to you if you don't have the expertise to understand that information. This information also doesn't tell you a lot about who's utilizing Bitcoin. So on their own, these addresses don't tell you anything about who owns the Bitcoin that's being used to transact on the blockchain. However, when we combine the information from the blockchain about transactional data that shows us that a particular transaction occurred at a particular time, and we take that and we combine it with other sources of information, it's possible to link transactional data from the blockchain to information about real-world identities to determine who's transacting with who, whether it's in Bitcoin or many other crypto asset ecosystems. Now, if we consider an example from July of 2020, we can understand how this can be used to hinder criminals. Now, in the summer of 2020, July of last year, some hackers managed to compromise the accounts of a number of celebrities, such as Elon Musk, politicians like Barack Obama, and others. It's become known as the Twitter hack. It was a very significant security breach of Twitter's systems. And you can see here an example of one of these hacked accounts. It was an account belonging to Elon Musk. The hackers hijacked Musk's account, and they used it to solicit Bitcoin payments from the public. And you can see here the hackers have written, pretending to be Elon Musk, "I'm feeling generous because of COVID. If you send me your Bitcoin, I will double your investment if you send me some funds." And he says, please send funds to essentially to this Bitcoin address. And you can see I've circled in red a Bitcoin address. Now, unfortunately, many innocent people were fooled by this scam, and a number of victims sent funds to the hackers of this account. However, because all of this activity is public and these hackers included their Bitcoin address on Twitter, at Elliptic, we were able to utilize this information to view how funds were being sent to and from this Bitcoin address and to learn about how these criminals were attempting to move their money. Now, what you see here on the screen is a picture of an image we created at Elliptic, and this is based upon an investigation we conducted into that hack of those Twitter accounts. Now, using that information from Twitter, provided us a clue about which addresses were being used to receive funds from various victims of the scam. And we were able to trace funds belonging to those criminals. So what you see in the middle of the screen is a dot that's labeled Twitter scam, July 2020. This is the group of addresses, or the cluster of addresses, as we call them, belonging to those hackers. By putting their addresses on public and on Twitter, it made it very easy for us to associate those addresses with the blockchain records that were maintaining information about all of their transactions. You can then see various lines and arrows moving from that Twitter scam circle to various other dots on the screen, which represent other Bitcoin wallets. So what we can see here is a visualization of the flow of funds as these hackers tried to move those funds from their own wallets in the center to other wallets so they could launder the proceeds of their crime. So the important thing to understand about this type of information is that regulated businesses and law enforcement agencies can use this capability to identify and track information related to this type of illicit activity. When it comes to regulated businesses, if they find that their customers may be engaging in transactions that are associated with an incident like this, they can file suspicious activity reports, notify law enforcement, and law enforcement can use that information to pursue the criminals of activity, illicit activity using Bitcoin and other crypto assets. And in the case of this particular hack, that's exactly what happened. As you can see from the headlines on the screen, crypto asset exchanges around the world were able to use AML solutions or anti-money laundering solutions like Elliptics to identify transactions associated with this scam, block those transactions, and file reports with law enforcement agencies. Law enforcement agencies in the US and the United Kingdom were able to identify the criminals involved in this case and arrested them in only 16 days after the attack was launched. So I think this helps to demonstrate that despite what many people believe, crypto assets are not a perfect vehicle for money laundering. They are highly traceable, and that traceability can be used as a powerful way of countering illicit activity in the crypto asset space. Now, I want to turn to the second myth that I raised earlier in my presentation, and this is the notion that crypto is completely unregulated, or it's just the Wild West, as some people refer to it. Now, one common misperception about crypto is that you can use it without any oversight. And I think if you went back a few years ago to about 2015, there was some truth to that statement. If you can see a map here, I created a map that demonstrates countries that regulated crypto in 2015. And you can see back in 2015, there was really only one country that had anti-money laundering regulation in place for crypto assets, and that was the United States. And for a long time, many other countries did not really have any regulation in place around crypto asset exchanges or crypto custodians that require them to apply anti-money laundering measures. That meant that criminals could access platforms in many parts of the world without having to submit know your customer information or be subject to other anti-money laundering controls. And this was a major gap that did influence the volume of illicit activity in the crypto space for some time. However, starting around 2018, things began to change, and more countries started implementing anti-money laundering regulation for crypto. And the picture today is now much different. So you see here an image of the same map, but colored in to represent the current state of play when it comes to regulation of crypto. Now, I've shaded in countries in green in this map. Those are countries that either have already developed regulatory frameworks for crypto activity, or countries like Ukraine that are advanced in the process of understanding how they may develop a regulatory framework for crypto and are planning to do so. And this, as you can see, really applies to most major financial centers globally today. In most major financial centers, there is some regulation in place that requires crypto asset businesses and other participants in the ecosystem to apply anti-money laundering controls. And the aim is to allow crypto activity to exist, but to make sure that those participating in certain types of activity are regulated. Now you can see on the map, I've also shaded in some colors in red, countries like China and Saudi Arabia. Those are countries that have banned quite a bit of, or most, crypto asset activity, China being the most famous example. Then you can see some countries in orange, like India, Russia, Turkey. These are countries that have prohibited some crypto activities and banned some, but have permitted other activity and maybe regulating some activity, even if they've prohibited others. Now, as you can see, there are some varied approaches across the world. I think most countries are leaning towards regulating crypto assets and crypto asset businesses. Some are taking a harsher approach. But I think the main lesson here is that there's now extensive regulation in place in many countries around the world. There's increasing alignment across countries, and it's increasingly difficult if you are a criminal or other malicious actor to be able to access crypto asset services in most countries around the world now without encountering some regulation. Now, a key driver of this activity and all of this regulatory activity has been the Financial Action Task Force. The Financial Action Task Force, or FATF as it's known, is the global standard setter for anti-money laundering regulation. And it sets out baseline standards that countries should implement to deal with risks like money laundering and terrorist financing. And over the past several years, the FATF, or the FATF, has issued various pieces of guidance, and you can see examples here on the screen, to assist countries in understanding how they can apply AML regulation to the crypto space. So countries around the world are working to meet these standards as we speak, and it's strengthening the global regulatory framework for crypto assets. Now, the FATF's guidance, or the FATF's guidance, establishes a few principles that I think are important to understand about ensuring that there's a robust global approach to regulating crypto assets. Now, the first component of guidance the FATF has set out is that it's clarified who needs to be regulated. It's created a definition, what we refer to as a virtual asset service provider, or a VASP. So businesses like crypto asset exchanges, custodial wallet providers, crypto automated teller machines, or ATMs, and other financial services providers who utilize crypto assets, and states that they should be regulated. And this provides countries with guidance in understanding what types of businesses should be regulated when they handle crypto assets. It also says that countries should mandate the registration or licensing of those VASPs by local authorities. So the FATF's guidance really states quite clearly that all countries should be taking steps to make sure that any VASP operating in their jurisdiction is registered with the appropriate authorities and subject to supervision. The FATF's guidance also sets out what types of anti-money laundering controls VASP should apply. So it states, for example, that they should be able to do things like apply blockchain analytics to identify suspicious activity, as in the case of the Twitter hack. And it also established a virtual asset contact group to monitor implementation. So the FATF is very closely watching how countries are implementing its guidance, looking to see if they're meeting its standards, and really working to ensure that there's a more cohesive global approach to regulating crypto assets than existed several years ago. Now, I think one of the ultimate consequences of this, again, is that it's making it much more difficult for criminals to access the crypto asset ecosystem globally. And I think we actually even have evidence that this is the case. Now, on this slide, you can see here, I've presented a chart that we created at Elliptic that shows the proportion of Bitcoin transactions historically linked to criminal activity. Now, because the Bitcoin blockchain is very transparent, we're able to collect a lot of information about macro level transactional flows in Bitcoin and can understand the overall volumes of illicit activity that are taking place in the Bitcoin ecosystem. And so at Elliptic, we did some research to try to measure what is the actual volume of illicit activity that's been taking place in Bitcoin. And as you can see here from the chart, we estimate that today, less than 1% of Bitcoin transactions involve criminal activity. And you can see that this marks a really dramatic increase from several years ago. Back in 2012 or 2013, nearly 1/3, or about 30% of Bitcoin transactions were illicit. This was mostly attributable to the Silk Road dark marketplace that I mentioned at the beginning of my presentation, until it was taken down by law enforcement. But you can see that from 2013 across 2016 and beyond and to the present day, there's a steady and dramatic decline in the proportion of Bitcoin transactions connected to illicit activity. What accounts for this declining prevalence? Well, I believe it is both the underlying traceability of crypto assets, which make it much less attractive for criminals to utilize Bitcoin and other crypto assets than many people expect. But I also think it's the growing presence of regulation in the space and the growing regulatory perimeter and harmonization of regulatory measures across countries. So I think we can expect that as regulation is strengthened across the globe, that the prevalence of criminal activity in Bitcoin and other crypto assets should remain low as a total proportion of the whole. So just to summarize those points, again, crypto assets are highly traceable owing to the public nature of the blockchains where their transactions are recorded. Anti-money laundering solutions are widely utilized by regulated businesses and by law enforcement agencies that enable them to disrupt criminal activity. We see a trend towards greater regulatory clarity globally around crypto assets, with an increasing number of countries regulating this space. And again, criminal activity actually represents a very small proportion of activity in Bitcoin. So I hope this was informative and happy to answer some questions.
Great, thanks so much, David. It was really great information. We do have a couple questions to wrap up with. As a country thinking about its own implementation strategy of regulations for virtual assets, what are the top recommendations you would have in terms of compliance?
Yeah, so I think, I think as a country is going through the process of building out its regulatory framework, really the most important thing in my view is a very robust and meaningful dialogue between the public and private sectors, between regulators and the entities they will regulate. I think that's always important when it comes to any financial services, component of the financial services sector. But I think it's especially important in a space like the crypto asset space, where the technology can be quite complex, where the technology is changing extremely rapidly, and where there are new products and services being innovated all the time. And I think one of the probably most maybe significant failures I've observed, in watching the evolution of regulation in this space, is when regulation's been written in a bit of a silo, separate from a discussion with the private sector, because it is a complex space. And I think where we see that a regulation is most effective and created in the most effective way so that it does do things like deter criminals, it's typically where it's written in close consultation with the private sector, and there's a meaningful dialogue between both regulated businesses and their regulators.
Great. One last one. How can we ensure traceability and compliance while still maintaining privacy? Is that a trade that we have to make?
Yeah, it's certainly a tremendous challenge. I think it's no secret that Bitcoin is not especially private. I mean, as you can see from some of the slides I shared, it's extremely traceable. It is possible for us to glean a lot of information about what's happening. And that's hugely powerful for regulated businesses looking to comply with anti-money laundering regulation. It's also very, very powerful for the public sector and for law enforcement. But I think we do need to recognize that we don't want this to become a space where there is no privacy and where there's so much transparency that maybe the average person would not want to even utilize the technology. And I think there are some ways that you can do that. Now, one of the ways is to maintain some practical firewalls. So, for example, at Elliptic, we harness technology that allows us to trace the flow of funds in Bitcoin. We do not collect personal identifying information from regulated businesses about their customers. The information we take about certain entities and funds flows to and from those illicit entities sits completely separately from, say, customer data that's being held by regulated businesses. And we work very carefully to make sure that there is a clear delineation and a wall between the information we access and the information that regulated businesses maintain about their customers. I think in addition, it will be important to, I think for both regulators and regulated businesses to really look at some of the innovations and experimentations that are going on in the crypto asset space to utilize privacy technologies to protect privacy in a reasonable way. There are crypto assets that are less traceable than Bitcoin. You may have heard of some of these. They're frequently called privacy coins. In some cases, at a company like Elliptic, we can do some level of tracing of these privacy coins. Some, it's essentially impossible for us to trace them. But we as a business, even though we trace many crypto assets, we are not opposed to these privacy coins. I think what we would like to see is a regulatory framework that acknowledges the need for privacy, enables people to use privacy focused technologies in a responsible way, but also ensures that there is scope for detection of criminal activity. And so again, I think that is where things like a dialogue between the public and private sector are extremely important, because I think with the right balance of priorities, it is possible to get to a meaningful balance between privacy and traceability.
Thanks so much for the presentation and additional insight, David. I appreciate your time.
And thank you very much. Thank you everyone for the time today.